EOH remains in the red. The technology firm has posted an interim headline loss per share of 11 cents. It's a slight improvement on the loss of 17 cents it's posted previously. The group also reported a near 3% dip in revenue. It says this was due to a challenging trading environment, even as trading and tendering activity improved. Looking ahead, CEO Stephen Van Coller has an upbeat outlook. He says that following the firm's capital raise and closing out significant legacy items, EOH is now well positioned to execute its growth strategy. And Master Drilling has reported a record revenue for the year ended December. That's despite global markets and economic uncertainty. This helped lift headline earnings per share by 2% in dollar terms, or by 15% when translated into rands. The group, which provides drilling technologies and mining solutions and services, has declared a dividend of 52 cents. This is a 10.5% rise on last year's payout. Moving forward, Master Drilling says it will continue to focus on cost control, capital allocation and operational excellence. Spar has reported an 8.8% rise in turnover for the 24-week period that ended on March the 15th. But the grocer says it's done this amid tough trading conditions. The firm's highlighted cost of living pressures as its main challenges. Consumers across its territories are having to deal with elevated inflation as well as high unemployment. And Nampak's lightening its portfolio. The industrial packaging group plans to sell its liquid cartons business in South Africa, and it's also disposing of the issued shares of Nampak Zambia and Nampak Malawi. That's in a deal with 450 million rand. The transaction forms part of Nampak's turnaround strategy, which aims to raise 2.6 billion rand. The funds will be used to tackle its debt. And Barloworld's revenue has slipped 5.5% in the 5 months to end February. The diversified industrial group says this is reflective of the diverse and complex economic environment it operates in. In Southern Africa, revenue was hurt by a fall in machine sales due to lower demand from mining customers, while its equipment Eurasia unit felt the effects of a slowdown at its Russian division. And Tharisa has announced a plan to buy up to $5 million of its own shares. The chrome and platinum group metals miner says it's committed to capital discipline and believes that a share repurchase at its current valuation supports this. The group has stated that Tharisa shares are trading at a significant discount. And the stock has been negatively impacted by the PGM price environment, but Tharisa says that the market hasn't taken into account the strong co-product contribution from the group's chrome sales, where chrome prices have remained firm. And German real estate investment trust DKR plans to withdraw its secondary listing on the JSE. The company joined the local bourse in 2021 with the intention of attracting interested South African investors. Since then, it has engaged in various initiative and investor discussions, but those moves have not yielded the desired results from a South African market perspective. And so the firm says it will delist and instead refocus exclusively on its primary exchange and shareholder based in Frankfurt. Employment dipped in South Africa's formal sector. The latest print from Stats SA shows a decline of 1.8% in final quarter of 2023. That drop is largely due to job losses in community services sector, which shed over 200,000 jobs over the period. Stats SA has also cited job losses in the business services, manufacturing and mining industries. Further afield, Boeing is on a hunt for a new CEO. This amid a deepening crisis over safety and quality standards at the plane maker. Let's listen to this report for more.
Boeing is hunting for a new boss. The aerospace giant said this week that Chief Executive Dave Calhoun would leave by the end of the year.
We believe in our airplanes.
He's departing amid a deepening crisis over safety and quality standards at the plane maker. That follows January's mid-air blowout on a 737 MAX jet operated by Alaska Airlines. Though no one was killed in the incident, it raised new doubts about how well the firm's best-selling aircraft is made. The model had previously faced a long grounding over 2 fatal crashes traced to a design flaw. Now investors want to know who the firm could choose to steer it out of crisis. Chief Operating Officer Stephanie Pope had been seen as the heir apparent, but was this week named to run the firm's commercial airplanes division instead. Analysts say that could be a sign Boeing wants to bring in an outsider to signal it is serious about change. GE boss Larry Culp is one name being mentioned after he led a sweeping overhaul at the conglomerate. American Airlines chairman Greg Smith, who is also a former Boeing executive, is seen as another candidate. Having worked at the plane maker and one of its big customers, he knows both sides of the industry. Whoever is chosen, analysts say the firm seems to want a clean break with the past. Unions say it's time to put an engineer in charge again. That after widespread criticism that Boeing has put shareholder value ahead of product quality.
And over in Germany, national rail operator Deutsche Bahn has agreed to gradually reduce train drivers' working hours in a wage deal struck with union GDL, ending a month of disputes and nationwide strikes. There's more in this package report.
Germany's national rail operator agreed a wage deal with the key GDL union. Deutsche Bahn said it would reduce train drivers' hours as part of a move to end strikes. A so-called working time corridor will be set up. It allows train drivers to gradually reduce their working time to 35 hours per week by 2029 while keeping wages at the same level. Deutsche Bahn added those who wish to keep working a 40-hour week would get a 2.7% hourly wage increase. Both sides agreed there would be no more strikes for nearly 2 years as part of the agreement. They've settled on a salary increase and a one-off inflation compensation payment. Deutsche Bahn will hope the deal brings an end to months of dispute and nationwide strikes. Germany has been hit by a wave of industrial action. High inflation and staff bottlenecks soured wage negotiations in the transport sector. It's led to strikes in national rail, air travel and public transport.
Now, just weeks after enacting its long-discussed Digital Markets Act, the European Union is currently investigating 3 of the world's largest tech giants for any potential digital competing breaches. Here's our reporter, Anat Ndeva, with more.
That's right, Nolutando. Tech giants are currently under scrutiny. That's Apple, Alphabet and Meta for potential breaches of the EU's new Digital Markets Act, which of course aims to regulate competition in online services. And joining me now to provide further insight is Deutsche Welle's Lars Halter, who's currently standing by in Berlin. Lars, thank you so much for your time. What are the details of the new legislation?
Thanks for having me. So Brussels is going after Apple, Alphabet and Meta, investigating those companies for breaking the Digital Markets Act. Now, not to do those tech companies bidding, but it's a little rich that Digital Markets Act has been on the books for less than a year, and there's been a lot of movement on behalf of those companies to comply with it. Anyway, here's some details on what's behind it. The Digital Markets Act challenges the power of the tech giants by making it easier for people to move between competing online services like social media platforms, internet browsers or app stores. It's for consumer protection to avoid consumers becoming too dependent on one particular provider, but it's also to make it easier for smaller companies to compete in the market. Violations against the new act could result in fines of as much as 10% of the company's global annual turnover. So this investigation is something that companies are taking extremely seriously.
Lars, maybe elaborate on what specific regulations or standards these tech companies might not be adhering to.
Well, let's start with Apple as an example. The EU is trying to find out whether Apple complies with obligations to allow users to easily uninstall software applications on its iOS operating system, to change default settings on iOS as well, or to switch to a rival browser or search engine on an iPhone. Also, they're checking whether Apple is doing enough to make sure that users can find out about free of charge content that independent app developers might be offering outside the App Store. It's pretty similar for Meta, by the way, as for Alphabet or Google, to use the company's biggest brand. The EU wants to know if the company favors its vertical search engines such as Google Shopping, Google Flights and Google Hotels over those of rivals. And and whether it discriminates against third-party services on Google search results.
You, of course, mentioned a fine that will come with the violation of this act. What are the tech companies' sentiments?
They are worried. As I mentioned, the EU can seek fines of up to 10% of a company's annual revenue. That is insane and could put any company at an existential risk. However, the companies are also a little annoyed, and understandably though, because they say they have already deployed thousands of engineers to meet all the Digital Markets Act requirements. And it has been reported repeatedly over the past couple of months that they're making a serious effort to give users and rivals more choices. Apple says it was confident it's in compliance currently with the Digital Markets Act, and that developers throughout the process have incorporated the EU Commission's feedback into its changes. Google's comments sound similar. They say they have engaged constructively with the European Commission. We'll see how this turns out if Brussels agrees with their feedback being taken up, but it looks like this is definitely going to be a longer investigation.
Well, let's leave it there for now. We'll be keeping a close eye on this ongoing investigation. Thank you so much for your time. That was Lars Halter, who is with Deutsche Welle.